Good afternoon. My name is Thomas Seneca. I'm the founding partner of TM Wealth Management, and we're excited to share with you this afternoon taxes in retirement. And we'll kind of take some time today, go through a lot of the slides. If you would like copies of the slides, you just needed to indicate that at the end of the webinar, or reach out to our office and we can provide those to you. A quick disclaimer, this is information is for educational purposes only. This is not tax advice. This is not legal advice. It is more just to help you understand some of the considerations that you need to make when you are looking at taxes in retirement. We'd recommend that you get with your CPA to go through these specific ideas and thoughts so that you feel good about moving forward with your taxes in retirement. I wanted to share with you a quick little, I guess, commercial or a little bit about us, TM Wealth Management, and everything you need to know about us is in our logo. The first thing is, I started my career on Wall Street, working for Goldman Sachs and Deutsche Bank in investment banking. Did that actually on Wall Street in Manhattan, and then for a little bit in San Francisco. And one of the things that I learned about that is that number one, investment banking is not conducive to a family. And so for me, I needed to look for something else where I felt like I had the opportunity to have a greater impact on the people and causes that I care about most. And so what I did is I transitioned to wealth management because there I get to sit across the table from families and individuals and help them make good decisions with their money so that they can have an impact on the people and causes they care about most. And one of the important things that for me when we were organizing the firm was that we remain independent. We don't have a home office saying, hey, you've got to promote these products or these strategies or this advice. We work for our clients. And so we are purely independent as a firm. The second is I really wanted to stay boutique. So when I worked in Goldman Sachs and Deutsche Bank, these are large, what are called bulge bracket investment banks, thousands of employees, thousands of clients. And I just couldn't see how you could add value to that many people on a consistent basis. For us, we wanted to make sure we stayed relatively small so that we could continue to add value on a consistent basis to every client that we interact with. So boutique is important to us. And then wealth management. So for us, it's not just, hey, stocks and bonds, what are your investments? We want to look at everything that touches your financial life. So that can be investments, financial planning, estate planning, insurance, risk management, Social Security, Medicare, and of course, taxes. Now, we don't do taxes. We're not a CPA, but we know enough of where we need to bring CPAs in so that we can get the most efficient strategy for you. And then the last component for us is fiduciary. We are what's referred to as a registered investment advisor, registered with the SEC, and we have a legal obligation, the fiduciary standards, to do what's in your best interest. And so in that case, that means that we put the client at the center of everything we do versus in some standards, specifically the suitability standard, they kind of put the product at the center of what they do. And so that's just a little snapshot about us and a little bit about my background. And now we wanted to share with you specifically taxes in retirement. Some of you may remember Shaquille O'Neal started his career with the Orlando Magic. And in 1996, he signed a $120 million 7-year contract with the LA Lakers. Went out there and to work with or to play with Kobe. And Shaq was new to this money thing. And so he figured, hey, $120 million, 7 years, I've got plenty of money to spend. So the day he got to LA, he went out and spent $9 million in one day. I believe he bought 3 Rolls Royces, and he gets a call from his agent, and I think it was his agent slash consultant that said, hey, Shaq, you need to slow down. You're going to run out of money. He's like, what are you talking about? I'm getting like $17 million a year. I haven't even spent half of what I make. And his accountant was like, yeah, but after you figure you're in California, you got your state tax, you got your federal tax, you're probably going to be able to spend maybe $10 million. You're going to walk away with $10 million each year. And so for Shaq, that was a big learning experience. So it's not how much you make, it's how much you keep. And you've been able to see, I think that was a really big learning experience for Shaq because now he's a pretty good businessman and out there doing a lot of great things with his finances. So that's why taxes are so important. We want to make sure we're keeping more of what we make or what we have. And the challenge that we have in our country today, this is a graphic that looks at, our revenue compared to our spending. Now, this is somewhat outdated, but it's instructive. This was back in about 2015. They projected that maybe in 2031, all of our entitlements plus interest would consume all of our tax revenues. Well, in 2022, the US government spending was 36% of gross domestic product. And you can see right here, this graphic back in 2015 assumed that our spending would be somewhere around the 19 or 20% of, or 18% of GDP. Well, we've exceeded not only the GDP, but also our net interest that we're now paying on to cover all of our debt. All of a way of making the point that we don't necessarily have a revenue problem, we have a spending problem. And so one of two things have to happen in our view. Either Congress has to stop spending so much, or taxes have to go up. The revenue has to go up. And so that's why taxes is becoming a greater part of our practice and our advice, because it is having a larger impact on the ability for people to retire and also on the income that they're going to have when they do retire. And so Congress is looking for ways to generate revenue. And one of the key things that was evident to me back in 2020, when they were going through some negotiations in Congress to figure out how they're going to raise revenues, they talked about eliminating IRAs or changing IRAs to a way in which they could be greater taxed. And the reason behind that is that this graphic here illustrates the amount of assets in retirement plans. That can be IRAs, 401ks, defined contribution, defined benefit plans, pensions, just how much money is out there. And if you look at that, back in 2020 and 2021, it was 35 and almost $40 trillion in retirement assets. And so if Congress can figure out a way to either accelerate the tax on those, meaning making you take it out sooner, or eliminate some of the benefits to retirement savings, then they can start to increase the revenue so that now they have more to cover the expenses of the federal government. So this is all a way of saying that they are looking at these assets to figure out how can they tax them. And even if they don't change the tax, anyone that has a pre-tax 401k or a traditional IRA, you're creating, yes, it's great, we want to get that deduction, but we're creating a huge tax liability in the future. Some have referred to that as the retirement tax time bomb, that when we get into retirement, now we're going to have to start taking this money out, and it looks like tax rates are probably going to be higher than they are today. And so this looks at our historical marginal income tax rate, so the highest marginal income tax rate. And so most people right now feel like we're in a high income tax environment, but we're really not. If you look back historically, even back in the 1980s, the top tax rate was almost 70%. Right now, the top tax rate is about 35%. Looks like it's going to go to 37 in 2026, and who knows where it's going to go from there. But tax rates have to go up given the amount of spending and the amount of debt service that our federal government has. So as we look at that, Congress has made a lot of noise about where they're going to start getting that revenue. They've already eliminated the stretch IRA. They've talked about taxing unrealized capital gains. So before you sell anything, they'll tax it. Limits on IRA, 401k contributions, higher capital gains tax rates, no more Roth conversions, a reduction on estate tax exclusion amounts, higher minimum distribution. So there's a lot going on, and what the Wall Street Journal termed that this is going to upend 20 years of retirement planning and sticks it to the middle class. So what we want to do is help you get the advice and understand some things that you might be able to do to minimize your tax liability and plan for some of these tax rates going up. And one of the biggest challenges we have in retirement is longevity, right? We're going to live longer because life expectancy has changed. And this graphic here just illustrates the current life expectancy at retirement is about 83 for a male and 85 for a female. So that's if you make it to age 65, the probabilities are that a male will live to 83 and a female to 85. But that's the median, right? So the challenge is that when you adjust for affluence and education, those numbers go up dramatically. And for women, that can be in their early 90s of life expectancy when you adjust for affluence and education. So we've got a plan that we're going to live longer. And the longer we live, the more taxes we're going to pay. And so we've got to make sure we're adjusting these taxes, adjusting our game plan for this life expectancy and the potential increase in taxes. The other big challenge when you get into retirement is that there's a challenge that is called sequence of returns risk. So what that means is when you are saving and investing, you don't care that the market goes up and down. You just want to make sure it goes up. And so this graphic here just illustrates that while you're investing, saving and investing, it doesn't matter the sequence of the returns, right? So if you look at this graphic, the red line, the returns 29%, 18%, 25%. The order of these returns is reversed on the bottom line, right? So the 29%, 18%, and 25 is the ending percentage returns of the bottom line. And so you can see that even though the red line starts off really good and it tanks at the end, the reverse happening on the bottom line with returns tanking at the end and doing really well at the beginning and doing really well at the end, it doesn't matter when you're just saving and investing because you end at the same point, right? So in this case, you get an average 8% return when you're not taking money out. The sequence of the returns or the order in which you get the returns doesn't matter. Now, when we flip that to now you're taking money out, you're taking 5% out, and we've got the exact same returns that we had on the previous slide, right? 29%, 18%, 25%, ending with 14, 12, down 21, negative 12. Same scenario here, but now because we're taking money out, the top line doesn't run out of money because it started really well. The bottom line runs out of money because it started very poorly, because what happens is now you're taking money out. So when those good returns come, you don't have as much money to recover and get back to the same line as you did when you weren't taking money out. And this is the sequence of returns risk. And it takes a lot of planning because as you get into retirement, you've saved all this retirement money, this nest egg in your IRAs and 401ks and even taxable accounts. But now, how do we start to take this out so we don't run out of money? And we're living longer. So this becomes a bigger concern as we get into retirement. So what do? So common tax mistakes, taxes in retirement mistakes. So we've got here quite a few of mistakes that we wanted to highlight. But because today we don't have a lot of time, we're only going to focus on a few of these, 5 of these, because these are the kind of the key mistakes that we really want to highlight and have a significant impact on the income you have in retirement and your ability to retire. If you'd like to go into more of these or some of these, if you've inherited an IRA or you've got estate tax planning concerns, or you're looking at a rollover and you'd like to talk specifically about this, don't hesitate to reach out to our office. We'd be happy to just kind of talk this through with you, give you a short consultation so you can make sure you're making the right decision. And also, unfortunately, during our webinar today, we don't have time for questions or comments. But at the end of the webinar, you'll get the opportunity to submit some questions and we will get back to you to make sure you've got the information that you need to make good decisions. So the first mistake that we see in terms of taxes in retirement is withdrawal mistakes. So when you get in retirement, you've got all these accounts and now you've got to figure out, how do I distribute, how do I create income for me as I start to live on the assets that I've saved over the years. And normally what people do, hey, I don't want to pay any taxes, so I'm going to take all my money out of my Roth accounts, the tax-free accounts. And they're like, okay, well, and now I'm going to take money out of my 401ks and IRAs, the tax-deferred accounts. And in the very end, I'm going to take money out of my taxable accounts. The conventional wisdom to get better efficiency with your distributions is, hey, I'm going to take all of my non-qualified funds, all my taxable accounts. I'm going to start there first. And then I'm going to move to all of my tax deferred and then leave my tax-free bucket till the very end, later in life, and I'm not paying taxes. Even with this conventional wisdom, the same amount of money and utilizing this conventional wisdom will add 3 years of income to your nest egg, just by taking a little bit more of a strategic approach to how to distribute the assets. But what we want to do is be very sophisticated about where we take the money out and how it impacts the tax brackets that you're in. And so what we look at every year is we do what's bracket management. We say, okay, how much money do you need? And what is the tax liability going to be when we take the money out? So we look at non-qualified funds. And depending on your tax bracket, your capital gains tax rate can be anywhere between 15 and 20%. Then we look at your tax deferred. If we pull money out of that, you're going to pay your ordinary income rate. And that can be, as you see in this box at the bottom right, that can be anywhere between 10% all the way up to 37%, depending on where else you're getting income from. And then we look at the tax-free bucket to make sure to kind of fill in the bracket to make sure that we're not bumping ourselves up into another bracket. So the idea would be, let's say you needed, $100,000 for income. We'd probably say, okay, well, let's keep you in the 12% tax bracket. So we take a little bit from your non-qualified funds, your taxable funds, because that's going to get taxed at 15%. And then we'd fill up the remaining of the bracket with some of your tax deferred. And then let's say the remaining $6,000 that you would need, we'd pull that from your tax-free, because that $6,000, if we bump you over $94,300, that $6,000 can now get taxed at 22%. So we kind of fill in the bracket using these different buckets that you have, and kind of taking that sophisticated bracket management approach that can add 6 years to your income with the same amount of money. So it's important to take a more sophisticated approach and an annual view about how much money you think you're going to need, so we can manage the tax liability to make sure you're keeping more of your money and it lasts longer. So that's number one, is understanding how to strategically withdraw money in retirement. Then the second mistake that we see, and this is very common, is required minimum distribution. So we'll talk a little bit about the Secure Act 2.0 that was passed last year, but essentially the RMD, the required minimum distribution age, used to be 70 and a half. And what an RMD is when you have these tax deferred accounts, 401ks, traditional IRAs, at a certain age, the IRS says, okay, you've deferred the tax on these long enough, and it used to be 70 and a half. Once you reach 70 and a half, the IRS says, now we're going to force you to take money out, and we're going to tax it, because the IRS wants to get their tax revenue. And so what the Secure Act 2.0 did is change that from 70 and a half, which was very confusing and very difficult for people to calculate, to now it's age 73. So once you reach age 73, now you are required to take a certain amount out, and this is the calculation. You take the fair market value of your IRA, and then you use an IRS life expectancy factor table to determine what is the amount that you are required to take out of your IRAs and 401ks. And the challenge is that you've got to do this every single year, and you have to use the value of the IRAs or 401ks at the end of the previous year. So for 2024, you're going to take your RMD based on the value of your IRA in 2023. And then you've got to look at your life, your age, and use the life expectancy factor and find the right number to calculate it correctly. Now, the challenge for this is that there's a hefty penalty. It used to be, if you got this wrong, there was a 50% penalty of the amount that you should have withdrawn, in addition to the additional tax. So the Secure Act 2.0 changed that. So now it's a 25% penalty. So it's a little bit better, but it's still one of the most hefty penalties that the IRS levies. And so we want to make sure we're doing this correctly so that you're not getting hit with that penalty. Now, if you do get hit with the penalty, there is an option to try and correct it. That's the Form 5329. And that's where we want to let the IRS know, hey, we got it wrong, but we're self-correcting it. Usually they are very lenient in assessing that 25% penalty if you're proactive about adjusting it, but you've got to file that form. So making sure you've got your RMD calculation correct is really important, because we don't want to have our money go to penalties. And we also don't want to take out more than we have to have it get taxed. We'd rather that continue to grow tax deferred. Another thing when it comes to RMDs, we've got a lot of clients that like to do charitable giving, whether that's their local church or the local nonprofit, give them a few $1,000s, and that's great. And when you are in this RMD age, RMD age at age 73, there's something that's called a qualified charitable contributions, or distribution as well. So it's a qualified charitable distribution. What that allows you to do is take the RMD that you are required to take out and have that go directly to a charity, and not show up on your tax return. So if you're already doing some charitable giving and you have to do RMDs, this is a great way to lower your tax bill and meet your charitable giving. So you wouldn't want to do a QCD if you're just to avoid the tax, because it basically saves you maybe 20 to 30 cents on the dollar. But if you're doing charitable giving anyway, this is an efficient way to do it. So just in this example with Jim and Lisa, you can see in this charitable donation, if they just write a check, right, they've got $40,000 of a pension, they got $35,000 in Social Security, and they have an IRA RMD of $60,000 that they have to take out. So their total income would be $135,000. They've got their state and local tax deduction. They wrote a check for $25,000 to the charity, so they get $35,000 deduction, or the standard deduction at $27,000. Obviously, they take the $35,000. So that makes their tax liability in this scenario $18,795. Now, with a qualified charitable distribution, right, same scenario, everything's the same, except instead of writing the $25,000 check, they distribute directly from their IRA to the charity part of their RMD as a QCD, the $25,000. So only $35,000 shows up as their RMD in terms of taxable income. So their taxable income is $110,000. They don't have the charitable deduction. So now they can take the larger standard deduction, and that creates a tax liability of only $13,000, $13,462. So they're able to save, almost a little over $5,000 by doing the exact same thing that they did by making the donation and meeting their RMD, but did it in a way that was a lot more tax efficient. So that's $5,000 that you didn't have to pay that now is staying in your hands to be able to spend and meet your retirement goals. So RMDs and QCDs are really an important element, especially if you're at that age at 73. That's when you've got to start taking your RMDs, or if you're already in RMD age, you were already taking RMDs before they changed the age. Those are two elements to be aware of. Make sure you calculate it correctly. And if you're doing charitable giving, making sure you're looking at, does it make sense for me to do a QCD versus, itemized deductions? The other mistake is not making effective use of Roth IRAs. So those that may not know, a Roth IRA is just like a traditional IRA, except in a Roth IRA, you're paying tax on the money already, putting it into a Roth IRA, and then that money grows tax-free. So you will never have to pay taxes on that money again. And these are really important right now because in our view, we're in a low tax environment. So I'd rather pay today's taxes. So 20 years from now, when I'm pulling the money out, I don't have to pay the prevailing tax rate at that time, which might be, significantly higher. The challenge with Roth IRAs is they have limited who can contribute to them. So if you make over $240,000 as a married filing jointly filer, you cannot contribute directly to a Roth IRA. And if you're single, if you make over $161,000, you cannot contribute directly to a Roth IRA. So once you make it under those limits, and this is the top limit, there's some reductions that go into it. But if you can make a direct contribution to a Roth IRA, you should. The other downside to Roth IRAs is the amount that you can put in is also limited, and it's fairly small. So for example, for this year, you can put somebody that's over 50 can put $8,000 into a Roth. Somebody that's under 50 can only put $7,000. So, that takes a lot of years to be able to accumulate a significant amount into a Roth, but you should still do it. But the challenge is that you can only get a little bit amount into the Roth IRAs right now. But if your company has a Roth 401k, and given your current tax picture, if it makes sense, maybe you want to switch from, your pre-tax contribution to more Roth contributions. But there is another element to the tax code that allows you to do Roth conversions. And that's where you say, okay, I've got, let's say you've got $100,000 in a Roth or a traditional IRA, and you want to convert that $100,000 into a Roth IRA. There's no age restrictions in terms of being able to do that. There's just, you're going to have to pay the tax. You take the $100,000 out, pay the tax, put the remaining balance back into the Roth IRA, and that money grows tax-free. So it's just another way to get large chunks of money into Roth accounts. But the challenge is you got to pay the tax right now. And so you want to make sure you're planning for that. And if you can pay the tax out of proceeds other than the conversion, then you're able to get more money into a Roth IRA if you pay the tax somewhere else. So a couple of the benefits when we look at Roth conversions, you can increase tax-free savings, you hedge against rising taxes. There's estate strategy benefits. So if you're concerned about estate tax, when you transfer Roth IRAs to your heirs or beneficiaries, there's no tax. When you transfer a traditional IRA, they have to take the money out and they're going to get taxed at their highest tax rate. Provide some tax diversification. And also Roth IRAs have no RMD. So even you hit 73, you are not forced to take money out. So that's another nice benefit, that you're not increasing your taxable income unnecessarily. Some considerations with doing a Roth conversion is you want to make sure you've got some time to let the Roth IRA work. You want to look at your current tax bracket to make sure what you're going to pay is reasonable, and what your tax rate's going to be when you're retired. And then how are you going to pay the conversion tax, right? So in my example, if you convert $100,000 and you're in the 22% tax bracket, there's going to be a $22,000 tax liability. And how are you going to pay that? Where's that money going to come from? It could come from the money you pulled out, but then that means you're only going to be able to get $78,000 into the Roth IRA, and we'd really like to get the full amount. So those are some of the considerations. But let's run through an example. So a quick example of the mathematics of a Roth IRA conversion is important, because if tax rates stay identically the same, you are no better or no worse off by doing a Roth conversion. Let me make that point again. If tax rates stay the same, you are no better and no worse off by doing a Roth conversion. So let's look through an example. So in a traditional IRA, so you've got $1 million and you've got an income tax rate of 25%. So what that means is that it's going to grow at 77% a year. And again, we're not compounding. This is a really simplified example, but let's say after 10 years, the aggregate growth is 70%. So that would mean at the end of 10 years, you'd have $1.7 million in your traditional IRA. You take the money out, again, simplified example, you take all the money out, you're still in the 25% tax bracket, so you'd pay $425,000 in taxes, and you could then spend $1.275 million. That's in the traditional IRA. Roth IRA, let's say you have $1 million, you pay the tax now at $250,000. You have $750,000 now after tax, and then it grows at 70%, same growth rate. So at the end, you now have $1.275 million to now spend tax-free. There's no taxes associated with it. So in that scenario, same growth rate, same tax rate, you're no better or no worse off in terms of the amount of money that you can spend. So now I want you to keep an eye on this little left corner box right here of the traditional IRA, and see what happens when we change this tax rate from 25% to 45%. So I'll go back and you can kind of see how it works, right? So we go back, it's $425,000 is the tax you're going to pay at 25%. If we go and say now the tax rate is going to be 45%, that's the only thing that we changed was the 45%. You can see same growth rate, 70%. Same growth rate for the Roth IRA, 70%. So now if tax rates go up, now I'm going to pay $765,000 in tax, and I'm only going to be able to spend $935,000. With the Roth IRA, because I paid the tax back here at 25%, now I still have the same $1,275,000 to spend. So you can make the argument that, hey, in the future, I'm not going to have as much income. I'm going to be in a lower tax bracket because I'm retired and I'm not working. And for years, for decades, that's actually worked out okay. The challenge is right now is that they're raising both the tax rates, but also the brackets that you might be in. And so you may have lower income, but the bracket that you're in may have a higher tax rate at that point. And so it really does make sense to have an additional bucket of Roth IRA funds or Roth 401k funds that you can now have a tax-free bucket to pull from. And so as we look at this, what we recommend, because we don't want to do a full $1 million, Roth conversion, because that's going to bump you up here in this top tax bracket at 37%. But what we want to do is again, bracket management. So let's say that you are a married filing jointly filer, and you make $150,000 your adjusted gross income. And so that would put you smack in the middle of the 22% tax bracket. We're going to pay 22% tax rate on every additional dollar anyway. So let's fill up that bracket with a Roth conversion. So if you had $150,000 of taxable income, we do a $50,000 Roth conversion. Now you've got $50,000 in a Roth IRA, and it hasn't had you exceed the 22% tax bracket. And if we continue to do that every year that you're eligible, then you'll build up a significant base of assets in a Roth IRA, but still staying in kind of that lower tax bracket or whatever tax bracket you're in, and just filling that up on an annual basis every time you look to do your taxes. Roth conversions are an important element to doing some tax planning, but there's some concerns about doing Roth conversions that I'll talk about later, specifically when it comes to Medicare. One other element I want to highlight for Roth conversions, because some people are like, well, I make too much money, I can't contribute directly to a Roth IRA. There is a strategy called a backdoor Roth IRA. And this is not some Cayman Islands, type of strategy that we've tried to, outwit the IRS. The IRS is very aware of this. They have not shut it down. They haven't come out and specifically said, hey, we approve of this, but they have never gone after anybody for this, and it's been going on for decades. And the way that you would do this is you say, okay, well, I'm going to contribute to a traditional IRA, even if you're covered by a 401k plan and you do not get the deduction, because you can still contribute even though you don't get the deduction. So that means if you're not getting the deduction, that means you're putting after-tax money into a traditional IRA. Totally allowed. But now what you can do is you can convert the traditional IRA into a Roth IRA. And because you put after-tax money into a traditional IRA, money that's already been taxed, when you convert it, meaning you pull it out of the traditional IRA and put it into a Roth IRA, you have to pay tax on any gains and any money that has not yet been taxed. But because the money you put in has already been taxed, then you don't have to get taxed again. And so what that means is, let's say you put $7,000 into a traditional IRA, you immediately convert it into a Roth IRA, there's no gain, you've already taxed. So now there's zero tax associated with converting the traditional IRA to a Roth IRA. And so now you've got money in a Roth IRA. You have to fill out Form 8606 to say, hey, I made a non-deductible traditional IRA contribution. And then you do that every single year that you can. And the nice thing is you can still do that this year for tax year 2023. You can contribute to IRAs before April 15th. So before you file your taxes, you can still do an IRA contribution for the previous year. The one thing to be aware of is this pro rata rule. And what that looks at is it says, hey, you can't just say you're just gonna convert this one IRA. You've got to look at your IRAs in aggregate. So for example, let's say you've got an IRA at Fidelity, you got an IRA at Schwab, and you've got an IRA at Vanguard. You can't just tell the IRS, well, I just converted the Vanguard IRA. From the IRS's standpoint, all of those IRAs are one. And so you've got to add all of those together and divide what you're converting by that number. And that's how much is tax free in terms of the conversion. And so if you have a whole bunch of IRAs out there, this might not be the best strategy. But if most of your assets are in a 401k, then this could be a good strategy, because 401k assets are not IRA assets and do not apply to the pro rata rule. So just wanted to highlight that, because that's a strategy, especially if you're younger, that you can continue to do year after year. And you figure you do that for 10 to 20 years. At a minimum, you've got $70,000 to $140,000 with no growth in a Roth IRA. And if that grows, then you could have a few $100,000 in a Roth IRA just by doing this strategy systematically every single year. Now, let me highlight this Medicare IRMA mistakes. That's another mistake that we wanted to highlight. So those that may not be aware, when you turn 65, you can then apply for Medicare. This is the healthcare system that we have put in place as a country for retirees or people that are 65 and older. You can apply for Medicare, and the current premium on Medicare is $174.70 a month per person. But that only applies if you are a joint filer and your adjusted gross income is $206,000 or less. If your adjusted gross income hits into any of these other brackets, then your premium goes up to a maximum of $594 per person. And the challenge is that the way Medicare calculates the premium and where you fall within their IRMA premium is they look at your tax returns 2 years ago. So 2022 is what's determining your 2024 Medicare premium. So why this is important is when you start doing Roth conversions add to your income. And you want to make sure that as you look at doing Roth conversions, you factor in that 2 years down the road, this income may impact your Medicare premiums. And if it significantly changes which bracket you're in, you want to be aware of that so that you're not doing a Roth conversion that gets you more money into a Roth IRA, but now you've increased your monthly spend because now you're having to pay this income-related monthly adjustment amount for your Medicare premiums. So just be aware of that. Also be aware that, if you're expecting bonuses or, big income a few years before you apply for Medicare, you may want to see if there's ways that you can push those out or have those spread out over time so that it doesn't bump you up into this larger bracket for IRMA and your Medicare premiums. So that's an important element to be aware of as well. Another mistake that we see is not being aware of your capital gains and capital losses, and specifically taking advantage of tax loss harvesting. So tax loss harvesting is is a strategy in which you sell securities or investments that have lost money, realize that loss to use it to offset future gains. So let's say you bought Apple stock let's go through the example we've got here with Joe and Sue. They bought $100,000 of SPY last year, and then it lost $30,000. Now it's worth $70,000. So they say, look, we're out. We're going to sell the SPY. So they've now they've realized a $30,000 loss. So then they sell it and they purchase another large cap value fund. So they're still invested. And that fund goes from $70,000 to $92,000. So that fund has now gained $22,000 of gain. So if they sell the $92,000, sell that large cap value fund that now has $22,000 of gain, they can offset that gain with the $30,000 of losses that they had realized by selling SPY. And so if we look at this specific example here, right? So, $5,000, the benefit that they had is, $30,000 of losses, right, from the SPY. Now that $30,000, they had a $22,000 gain by selling the other fund. They can use, and anyone can use $3,000 of long-term or of capital losses to offset ordinary income. So that shows up on the first page of your tax return. And that's the maximum every single year. So now they've realized the $22,000 gain. They've offset that with the $30,000 loss. They've used $3,000 of that gain or that loss to offset ordinary income. So they have $5,000 that they can't use in that tax year because they don't have any more losses and they can't, or any more gains, and they can't use it to offset ordinary income. So that $5,000 rolls over what we call a tax loss carry forward to the next tax year to use against any future capital gains. And so you look at that and it saves them, $4,200 in taxes because of that strategy. And if they had just kept the SPY, if they'd kept the SPY, didn't sell it here, and it went up to $92, then they sold it, they would only be able to realize $8,000 of losses. So a tax loss harvesting strategy, something you look at every month to say, hey, let's say I own Home Depot and it's down $1,000. Let me sell Home Depot and maybe buy Lowe's, still have my home improvement big box store exposure. But then as Lowe's goes up, if home improvement goes up, then you can sell Lowe's and use your Home Depot losses to offset the gain that you received by reinvesting in Lowe's. So it's an important strategy. Now, we don't want to go out there and create losses just to lose money so we can offset future gains. But in investing, there is inevitably investments that we make that don't always work out. And even on a monthly basis, these can just be normal fluctuations of the market that a specific security is down for 1 month for whatever reason. and we realize that loss, and then we can use that loss to offset future gains. But we want to stay invested. So once we realize that loss, find a comparable security to stay invested so that you can still participate in the market. Then there's a number of rules that go along with it, meaning you can't buy the same security within 30 days and some other elements that go into it. But it is a strategy that can really be helpful in terms of meeting your tax efficiency needs within retirement. Okay, let me focus now just a little bit on the Secure Act 2.0. This is some legislation that was placed into action about in 2023. And it's got a lot of elements, a lot of moving parts, and some of the things have changed. But I'll focus, down here in 2023, they changed the RMD age to now it's 73. And then in 2024, a lot of new elements come into play. Number one is 529. You can now transfer a portion of 529s if you're not using it for education expenses into a Roth IRA. That's tremendous. That now allows people that maybe overfunded a 529 to get it into a Roth IRA. There's a lot of rules around that in terms of who can do it, how much, who needs to own the account. So there's a lot into it, but just be aware of that and get ready to maybe utilize that should you have overfunded a 529. Another element, this Roth catch-up contributions required if prior year wages were greater than 145,000. That now has been pushed out till the end of 2025. So that really won't kick in until 2026. And what that is if your wages last year were over $145,000 and you're making 401k contribution, catch-up contributions, this is if you're over 50, in 2026, those catch-up contributions now have to be Roth catch-up contributions. And so just be aware of that. QCD amounts now a lot of these things are now linked to inflation. So we're going to see increases in QCD amounts, IRA contribution amounts, and a number of those things to be able to keep up with inflation. Another element that I just wanted to highlight for you as well is in 2025, people that are age 60 to 63, you're going to now be able to eligible for a special catch-up contribution of either 10,000 more dollars, or 150% of what the standard catch-up limit is at that point in time. So just be aware of this is coming next year. If you're in a 401k and for IRAs, you're going to get some additional catch-up contributions that you can now make into IRAs and 401ks to be able to accelerate your retirement savings and also manage your tax efficiency, because now you can put more money into these tax advantage vehicles, IRAs and 401ks. Okay, we covered a lot, and I kind of went through it quick, but I wanted to try and hit on some key elements. And the question then it's always, okay, so what do I do now, right? We covered a lot of things. Maybe it applies to me, maybe some things I've got some more questions on. What can I now start to do to be more tax efficient? And here's kind of the framework that we would recommend. First is kind of get organized. Figure out what your current tax rate is, where your income's coming from, what accounts do you have, where are they? Are they IRAs, traditional, Roth? Do I have 401ks? Do I have old 401ks out there? Figure out what you have and where it's located. And then conduct a tax analysis. And this doesn't mean you need to go to a CPA, which we would recommend if your situation's complex, but just go through and say, okay, let me look at my tax return last year. Where is my income coming from? Which tax bracket is my top tax bracket? And where do I think I'm going to be this year in terms of what income did I get last year that maybe I'm not getting? Maybe I got a raise and that's going to increase my income. Am I withholding enough so that I'm not having to write a check to the IRS when I do my taxes? And then as you get into retirement, establish an income plan. How much money do I need? And where is it going to come from? How much is coming from Social Security? How much might I be getting from pensions or annuities or insurance? How much am I going to get from my assets? How much dividend income maybe am I planning on? And so once you have those three elements, then you can start to develop that plan and implement it. And then review it every year. So for our clients, we review their income plan at the end of every year to say, okay, what is next year going to look like? So now we can start to do some planning. Maybe we take a little more out this year to kind of fill up that bracket, maybe do a Roth conversion, right? So now we can be more tax efficient with everyone to make sure that they are getting the maximum use out of the assets that they've saved over time. Another thing that we would recommend, and this is something that we do, is do an initial consultation, right? So our goal is to really to educate and help people make good decisions with their money. And if that means that, hey, we establish an ongoing business relationship, that's great. If not, that's okay. We just want to make sure people have the information to make good decisions for them. And remember, we're a fiduciary, so we want to do what's in your best interest. And so when we do our initial consultation, it really is about giving you the information that you need to make good decisions. And then we can jointly decide if it makes sense to have an ongoing relationship where you could get value out of that. So with that, we appreciate you spending some time with us today. We also would encourage you to stay registered for our webinars. We do these every month on different topics. We've got one that we did at the beginning of the year in election year investing. We've done it on estate planning, now tax planning. We'll do it on financial planning. So just take a look at what we've got on our events page on our website, and feel free to continue to register for these webinars. And we hope you've got some information that will be helpful to you to be more tax efficient with the resources that you have, so you can have a greater impact on the people and causes you care about most. Have a great rest of your day, and thanks for joining us.